In today's engaging video, we'll delve into a curated list of 12 undervalued dividend-paying stocks worth contemplating for your portfolio. Don't forget to hit the like button and subscribe for our weekly financial insights. When evaluating underpriced dividend stocks, you need to scrutinize both the dividend yield and the company's overall fiscal health. A high dividend yield may seem appealing, but if the company is financially unstable, the dividend may not be sustainable. An underpriced dividend stock typically trades at a price less than its intrinsic or actual value. Several reasons could account for this, such as short-term financial troubles or overall market decline. To spot these gems, you can consider the dividend yield, calculated by dividing the stock's current price by its annual dividend per share. While high yield can be a good indicator of an undervalued stock, it's not the sole criterion. You should also pay attention to the company's financial stability, growth prospects, and other pertinent metrics. Now, let's shift gears and delve into our hand-picked list of 12 underappreciated dividend stocks. Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. Let's kick things off with Crown Castle. This is a real estate investment trust, or REIT, that specializes in cell towers. Now, despite experiencing a stock price dip in 2022, analysts are still bullish about it, projecting a 3% growth this year. What really stands out is its dividend yield of 6.31%. That's because REITs like Crown Castle are legally mandated to distribute a whopping 90% of their taxable income as dividends to shareholders. Next on the list, we have the pharmaceutical giant Pfizer. It offers a dividend yield of 3.6% and currently stands at $47.72 per share. Though it's down 20.3% year over year, don't let the dip scare you away. Its forward PE ratio of 10.6 suggests that it could be a good buy for value investors. Now let's talk food. Kraft Heinz, to be precise. Even though its stock has declined by 16.24% year-to-date, it remains a solid defensive play, offering a dividend yield of 4.79%. Switching gears to tech, we have IBM. With 27 consecutive years of dividend hikes, IBM offers a yield of 4.5% and a stock price of $132.49 as of April 1st, 2023. Thirsty for more? How about Coca-Cola, a name known globally for its extensive beverage line? It offers a dividend yield of 3.3%, with a stock price of $58.87 as of this month. At number 6, let's look at ExxonMobil, the energy behemoth. It's hard to ignore its tempting 5.9% dividend yield, especially when the stock was priced at $64.20 as of April 1st, 2023. Next up, Procter & Gamble, a real titan in the consumer goods sector. It offers a dividend yield of 2.4%, and its stock was standing at a noteworthy $142.19 on our reference date. Next up is Walgreens, a household name for pharmacies across the nation. Walgreens offers a respectable dividend yield of 4.2%, with its stock price sitting at $56.41. Let's not forget about the energy sector, and in that regard, Chevron is worth a look. The stock comes with a solid dividend yield of 5.2% and was priced at $115.24 on our reference date. Moving on, let's talk about General Electric. Now, the dividend yield here is on the lower side at just 0.3%, but don't let that fool you. GE has a diverse portfolio and stood at $106.62, making it an interesting option for a well-rounded portfolio. Next, we have Merck, a name that needs no introduction in the pharmaceutical sector. Merck offers a dividend yield of 3.2%, and its stock price stood at $88.16. The forward PE ratio for this stock is 14.8, which is slightly above the industry average but could be a good pick for some. Last, but certainly not least, is Energy Transfer. Specializing in fuel transportation, this stock is hard to ignore with its very high dividend yield of 9.55%. What's more, it recently acquired Crestwood Equity Partners, for an impressive $7.1 billion, signifying possible future growth. In the past year, high-growth stocks have been a roller coaster ride. If your portfolio is heavy on them, you may be rethinking your strategy. Here's where dividend stocks can offer a lifeline by providing stable returns. But there's more to them than just that. One of the most attractive aspects of dividend stocks is their high yield. This is especially beneficial for income-focused investors like retirees. Instead of relying solely on the Social Security net, dividends offer an additional income stream. While dividends are the main attraction, let's not overlook capital appreciation. Many dividend stocks are undervalued, which means they have the potential to rise as market conditions improve. In other words, you get the benefit of a steady dividend yield, plus the opportunity for the stock price to go up. Risk management is crucial in investing. Dividend stocks offer you the chance to diversify your portfolio across various sectors, like technology, healthcare, and energy. This not only minimizes risk, but also provides multiple avenues for growth. Another great thing about dividend-paying companies is that many of them increase their dividends over time. This could effectively give you a raise every year, something especially important for long-term investors or those relying on this income during retirement. So there you have it. If you're feeling uneasy about your high-growth stock investments, maybe it's time to consider adding some dividend stocks to your portfolio. They offer high yields, capital appreciation, diversification, and the potential for growing dividends. A pretty compelling case, don't you think? Before we go, don't forget to like this video and subscribe for more finance tips and strategies. Until next time, happy investing.